Thank you for still being with us for the third and last panel of today's conference. My name is Bernd Löwen. I'm Chief Risk Officer and Chief Financial Officer of KfW in Frankfurt, the German State Development Bank, and I will have the honor to chair this panel. The topic of the panel overall will be workings of the new regulatory framework, and we hope to bring some new aspects into the debate which have not been mentioned and discussed on the panels and in the speeches before. We also have the honor to have two keynote speakers here. The first keynote speech will be by Mr. Frieden, Minister of Finance of the Grand Duchy of Luxembourg, and his topic will be the post-crisis role of finance. Afterwards, we will have the second keynote speech by Dr. Elke König, President of BaFin, the German financial service regulator, about financial regulation, achievement, and challenges ahead. Dr. König will afterwards also join us, so she has a dual role on the panel. Besides her, we welcome Stephen Major, head of ESMA, the European Securities and Markets Authority, and Emmerich Müller, senior partner of Bankhaus Metzler, the traditional and very well-known German private bank based here in Frankfurt. Mr. Frieden, the floor is yours.
Good afternoon. It's a great pleasure to be once again with you. It's, I think, the second or third time that I'm attending as Luxembourg Finance Minister this Finance Summit. And I'm sorry to not to speak too much about Cyprus today. Probably this morning it was more interesting. But I think some aspects which we are going to discuss this afternoon indeed relate to the general framework that we are setting up to make sure that Europe remains a place where financial services can be adequately developed. A few years ago, Joseph Stiglitz stated the obvious when he said that economic globalization outpaced political globalization. And the financial and economic crisis crystallized the contradiction we face today in the Eurozone when we endeavor to deal with the consequences of the monetary union and the interconnectedness of our economies. Last Friday, and there we are again, and last night in a telephone conference, we as Eurogroup finance ministers discussed the situation in Cyprus. Those were, I must say, very difficult meetings, and we could clearly appreciate the limits of political globalization in the Eurozone. I have to tell you that much work was done prior to the meeting of last Friday to prepare the conditions for a 17 billion euro program that Cyprus needs. It was felt, however, by some that because of the nature of the banking sector of Cyprus had to make an additional effort to reduce the amount to be allocated to only 10 billion euros. And it is therefore that after long hours of negotiations where many concerns were discussed, notably also the effect of a bail-in or a haircut versus an exceptional levy on the financial stability of the Eurozone as a whole, it was decided to adopt a one-off so-called stability levy applicable to some or all deposits. Our objective was and is to help Cyprus. That is, to prevent the default of Cyprus and the total breakdown of its banks, but also to take into account the effect of our decisions of the stability of the financial sector in the Eurozone as a whole. I think we constantly have to balance in Cyprus, but also in the other program countries, between the necessity to impose stringent conditions to move out of the catastrophic fiscal situation in a given country and the difficulty to impose hardship after hardship on the people who have to help re-establish a better fiscal situation by radically lowering their lifestyle. These are, as I said, no easy discussions and no easy decisions. But every case, and I would like to add every solution, was and is unique. And so is also the situation in Cyprus. And even though the banking sector in Cyprus must be rethought in order to become more sustainable, it is important not to underestimate the fact that Cyprus is also, to a large extent, the victim of the situation in Greece and the euro crisis as a whole. This is contagion. And we need to be extremely vigilant now and in the future, not to enhance this phenomenon by adopting measures that undermine the trust of markets and investors and continue to weaken rather than to strengthen financial stability. That's, by the way, the reason why in the meeting last Friday I did not favor an outright bail-in, unlike other colleagues, but rather an instrument closer to a known wealth tax or withholding tax. This interconnection is important to be kept in mind when we talk about the workings of the regulatory framework. So the monetary world, the financial world, the regulatory world are, of course, closely interrelated. We have always the same ultimate objective, and that is to regain confidence and ensure financial stability to prepare the post-crisis. We do not always achieve that right away, but the objective is certainly there. As you discussed today, this regulatory framework in the euro area, I think an important question that we have to ask ourselves is whether a European, i.e. a regional framework, is the adequate response to a global crisis. We took in Europe immediate action to ensure both short-term crisis management and the longer-term architecture of the Eurozone. The framework of fiscal and economic policies and governance was strengthened through the adoption of a number of European laws with these terrible names, a six-pack, fiscal compact, two-pack. Adjustment programs were designed, and of course we have established firewalls, EFSF, ESM, by the way, both established in my home country, Luxembourg. And it is within this context, and as part of this comprehensive policy response, that the idea of the banking union came up, and that we are now working on establishing this banking union. We knew from the beginning that the European monetary and economic union was far from being complete and perfect. Major elements of, in my view, necessary political integration of Europe were and are still missing. But I don't think that they are realistic in the short term. The fiscal rules were established, but often not complied with in many countries. And greater coordination between economic policies had been left unaccomplished, and they are still unwanted by some. The financial crisis exposed this asymmetric construction with force and caused the sovereign debt crisis in the Eurozone. We are now, of course, working, as I said, on several elements of this so-called banking union. This aims at an integrated financial framework, which is also part of the Four Presidents report, which President Herman van Rompuy has outlined. The goal of this integrated financial framework is to reduce the fragmentation of the European banking market, and thus meant to be implemented at the level of the entire European Union. Following the regrettable refusal of the UK to participate therein, it evolved merely towards a Eurozone instrument, and it became thus a corollary to the further integration of the monetary union. Without going into the details, which many of you know, let me just recall some of the main facts. The banking union refers to an integrated financial framework under which member states would coordinate their banking systems in at least three ways. One, common regulation and supervision. Two, common management of the resolution process for troubled banks. And three, common deposit guarantee fund. If we look at the first pillar, the one that we decided on in December last year, the single supervisory mechanism, I think again we have there several elements. A regulation giving strong powers for the supervision of all banks in the euro area to the ECB and to the national supervisors. A major step forward, I think, was taken in the last few hours. A regulation with limited and specific changes to the regulation setting up the European Banking Authority to ensure a balance in its decision-making structures between the euro area and the non-euro area, because we are in a single market of financial services. And 3, a communication outlining the EU Commission's overall vision for rolling out the banking union, covering single rulebook, common deposit protection, and single bank resolution mechanism. However, banking union cannot be limited to the single supervisory mechanism. We need to reach agreement on CRD4. We have made substantial progress, also in the last Council of Ministers of the European Union. We need a framework for ESM direct recapitalization, and we need to advance in negotiations on bank recovery and resolution directive, as well as on the proposed directive for deposit guarantee schemes. So there are many elements of a broader system that we have to set up if we want to complete the banking union as part of the integrated financial framework. I insist and encourage the Commission to present as soon as possible a proposal for a single resolution mechanism. This mechanism will further safeguard financial stability and ensure an effective framework for resolving financial institutions. The operational build-up of the SSM, the single supervisory mechanism, the ESM is already there, the SSM is in full preparation today. These were also difficult decisions to know exactly which banks should come under the supervision of the ECB, and the compromise was that banks with a total value of assets which exceeds 30 billion euros, or the ratio of its total assets over GDP of the participating member state exceeds 20%, would come under the control of the ECB. The mother company of the banks is taken into account when these criteria are applied. This will be very difficult in the implementation in a country like mine, which is one of the largest international financial centers in the Eurozone, where there are 150 banks. Half of the banks will come under the direct supervision of the ECB, the other half under the supervision of the National Supervisory Authority. But I also understand from the discussion that we had in the Council of Ministers that quite a number of operational prudential supervisory activities will be exercised by the national authorities and that the ECB would assume a general supervisory role, so as to work in close cooperation with the national authorities. I hope that the ECB will finish its work to start in March 2014 with its new important work. I believe that the ECB has an intrinsic and deep interest in a stable financial system, and therefore is the adequate institution of the European Union to deal with not only monetary policy, for which it was created, but also with this European banking union, or part of the banking union. However, we must make sure that it will not lead to an overly bureaucratic system. We have indeed introduced quite a number of new regulations in the past few years, and we must make sure that we find the right balance between an efficient system of supervision and a good functioning of the banks, which will not be burdened too much by national and European supervision mechanisms. The roadmap which I have outlined is largely incomplete to date. I have, from the outset, in many meetings that we had in Brussels and Luxembourg, insisted on the intrinsic interaction between the three main pillars of the banking union: the supervisory mechanism, the resolution mechanism, and the deposit guaranteeing scheme. A swift adoption of the resolution directive is an important prior step to the establishment of the single resolution mechanism. This is a question of coherence, but it's also a question of credibility. How can I accept to transfer supervision from a national level to a European level, and yet remain accountable when a bank encounters difficulties in my country? In this context, I also believe that the ESM must be effectively able to recapitalize banks directly. You cannot say A without B. This all goes together, and I think there is still some work and some reasoning to be done in the Council of Ministers and also in the European Parliament. Against this difficult background that we see today in Europe, I see, more generally speaking, two challenges that are linked also to the role of finance. The first one touches on the use, and in some cases on the abuse of the role of finance in the past 3 years. And the second one relates to the generally unstable economic environment. Clearly, the two are linked and have somewhat led to each other. Finance is something positive. Finance is the engine of our economies. It channels ideas into action and thus helps to create jobs. It must, however, be embedded in what the British economist, I think of German origin, Fritz Schumacher, describes so adequately as economics of permanence, when he writes, "Economically, our wrong living consists primarily in systematically cultivating greed and envy, and thus building a vast array of totally unwarranted wants." Financial centers today must be, I think, in this context, a role model for a new politics of what I would define, using a little bit Schumacher's words, finance of permanence. In other words, we need a sustainable business model, which must re-establish moderation as the cornerstone of economic reasoning, creating healthy and not unlimited growth and wealth, and not losing sight of the fact that money is a means to an end and not the end in itself. An unhealthy economic behavior that is deep-rooted in a system ultimately leads to economic instability rather than stability. Moving from principles to application, we can see today that an abusive, excessive, risky way of handling money has led to a systemic global crisis that touches all of us. We have to deal with this issue, you have to deal with this issue, and I think the regulatory framework can help to reorient financial services, the financial sectors, towards a less risky, less excessive behavior in the interest of the entire society. The United Nations Commission of Financial Experts wrote that this crisis, the crisis we are in, is not just a century accident. It is man-made. It was the result of mistakes by the private sector and misguided and failed policies of the public. The current economic crisis should thus give us the opportunity to question prevalent economic doctrines and public policies, as well as the issues of economic governance. The banking union is not necessarily a panacea. It can be pivotal in fighting the current crisis by breaking the vicious loop between sovereigns and banks. It is important that critical design aspects are not deferred and that strong euro area-wide supervision and safety net measures are implemented quickly, and by quickly I mean within the next year. What I'm missing in the current setup is a coherent link with the rest of the world. We are implementing G20 commitments and working hard on form and substance in order to put in place a sophisticated regulatory framework, and I described some aspects of that to you today. But if we want to recreate stability and trust in the world financial system, the European Union cannot act alone. The G20 cannot act alone. The G190 or 92 must adhere to common standards. This is where I think that economic and political globalization, to come back to Stiglitz, have not advanced in parallel. The reality is one of deep interdependence. The political response remains very often piecemeal. We need to be aware that regional standard setting does not lead to a general deterioration of competitiveness and greater asymmetry with other regions of the world, because this could potentially lead to another type of crisis. Indeed, one of the great challenges I identify in the various responses at the national level, at international level, is a tendency to resist globalization by adopting somewhat protectionist measures or policies. Maybe that was also one of the reasons of some decisions in the last few days. The fact that economic globalization has outpaced political globalization cannot lead to the conclusion that we have to undo what we have managed to achieve in the past decades. Besides this regrettable and subtle policy shift, such a beggar-thy-neighbor policy, typical, by the way, during the Great Depression, creates negative externalities that in turn impede the recovery from the crisis. Financial regulation in a post-crisis world must achieve stability and trust. But regulation can never replace the absolute need for financial institutions and actors, for you, to behave in an ethical manner, to take into account the long-term perspective and the common interest. And for us, as political leaders, to rediscover the merits of something that is well known in this country, the social market economy. We need today what I would call an international soziale Marktwirtschaft, which combines, and I think only the German language allows to express it in a perfect way, which combines das Prinzip der Freiheit auf dem Markt mit dem des sozialen Ausgleichs und der sittlichen Verantwortung jedes Einzelnen den Ganzen gegenüber. Regulation must contribute to reorient the role of finance to support economic and social development. Thank you very much.